Thank you very much for having me here at the Utah Global Forum. My name is Connor Duffy, and I'm the Chief Credit Officer for the Global Banking Group of Wells Fargo. We share global in our names. Our business is focused exclusively on helping customers with their businesses overseas or outside of the U.S., so it's all international. I spend 100% of my time working with customers and helping them with their international banking needs. So I want to talk to you some about risk mitigation. I have three basic topics that I want to review with you. One is some of the risk factors that we face when we're doing business internationally. Second is the importance of a risk culture, and I think that's a very, very critical aspect of managing our risk. And then we'll talk some about some of the risk mitigation tools that we can use for our international businesses. I think it's real important that we put risk mitigation into context. It's all about doing business, right? There's a yin and a yang between business development and risk mitigation, and it's important that the two work together and fit together in any organization. So here are some of our risk factors. You can tell I went to the marketing department with this because I think the colors are a little cheery for risk factors. But I don't know. Black and white, maybe shades of gray would be more appropriate. What you can see in risk factors when you move internationally is that there are a lot of them. So there are a lot more risk factors than you typically face when you're doing your business here in your local market. I think another important factor is that the degree of these risks is much more significant than we usually manage in our own domestic businesses. So, risk factors when you go internationally, we always embed them. We'd love to do our business just like we do it in the U.S., but we know when we cross the border, we're dealing with different legal systems, with different cultures, with different business practices that we all have to deal with. So Mr. Buffett says risk comes from not knowing what you're doing. So how do you know what you're doing? I would argue that the first step is having an effective risk culture. So I think risk culture is a critical aspect of any organization. In a small business, I think you see the risk culture really come from the owner, right? It's about the owner of the business and his confidence in what he's doing, right? And his concern about losing his own money, right? So those are very nice balancing factors. When you get into a larger organization, I think you start dealing with a number of organs that really kind of help you with your risk management, its roles, responsibilities, its policies and procedures. And I want to emphasize that these are what I think of as organs, right? I think that risk culture is the DNA. So I think the risk culture is what's embedded in all of the decisioning that the organization makes. I think it's inherent that, I encourage everyone to define the risk culture, to preach the risk culture. It's something that should be embedded at all levels of the organization. Words that I often hear associated with risk cultures: conservative. I like that one. I'm the credit guy. Relationships and knowing your relationships well. It's understanding your customers' businesses extremely well. It's the fundamentals that everybody in your organization and at all levels can understand and appreciate. Risk culture is, I think, not just about being smart and technical. I think being smart is necessary but not sufficient to properly manage your risk in your business organizations. I started my career with a Texas bank in the early 1980s, and it was one of very few AAA-rated banks in the country at the time. Within 6 years, it was government supported. And I think what happened there was, and by the way, I was not in management at the time, I think what happened there is that the risk culture really wasn't strong enough to protect it against the severe economic impacts that the business faced when oil and real estate collapsed in Texas. So, that risk culture is just an important piece of the DNA of the organization, I think, critical to really protecting and managing your business risk. So here's some risk management tools. This is where it does pay to be smart and to have that expertise to really help you manage your business risks. I think everybody recognizes these tools that we use to help us with our business internationally. I think what's really important about these tools is that the tools themselves have risk, that they aren't guarantees, right? They are just tools for helping you manage and protect your risk. I'll give you an example. We still use, quite frequently see letters of credit being used with our commodity customers that are exporting internationally. So, commodities by their nature, a bale of cotton is a bale of cotton. Yes, you have qualities, but there is a high degree of substitution that is inherent in any of these commodities. And also, there's a significant amount of price risk. Right? Prices go up and prices go down. So your risk is your bale of cotton's on the water and the price goes down. Now, if you have from your customer a letter of credit from their bank, and you basically provide the documents under that letter of credit in a clean manner, then you will get paid. You basically will get paid by your customer's bank. However, you have to present the documents on a clean basis, right? If there are discrepancies or issues with compliance of those documents, the bank is no longer obligated to pay, right? So then you're back to your commercial contract. If prices have gone up, you're going to have a very happy customer who I'm sure will take the goods from you at the contract price. If prices have gone down, then once again, you'd better have good clean documents under your letter of credit or a very good relationship with your customer. Another example is foreign credit insurance. Foreign credit insurance is a great risk mitigation tool for businesses to kind of protect you against the financial default or the financial risks that you have in your customers that you're selling to overseas. But insurance is a contract, right? So there are conditions in that contract that you must comply with, right? So when you go to present your claim under that policy, your insurer rightly will basically ask for you to demonstrate that you've complied with the terms and conditions of that underlying insurance contract. So it's very important to build the expertise internally to manage these these various tools, but also obviously encourage you to use your external resources. Your banker, of course, your insurance agent, your insurance broker, your lawyer, all can be very, very effective in helping you manage these various tools. And I think this is really important, and I think really kind of fundamental to any risk management is stay practical. That it's terrific to have the technical tools to help you with risk management. But fundamentally, it's about good practical business practices. It's the most effective form of risk management that I think you can have. So it's common sense, right? It's there are going to be winners and losers, and that they're good guys and bad guys. So pick the good guys, pick the winners, right? Build cushion into your businesses and your business plans. Do your downside analysis. It's all those kind of fundamental practical things that I think are really, really important in terms of managing your risk. So I just want to say thank you very much. It's been fun being here, and thank you.